cutting rates and providing liquidity. So given that INR bonds has always been at the forefront of providing cutting edge reports and analysis on markets over the last 7 years through its online platform, and through its training programs, online training programs. And given that we are anyway the pioneers in providing fixed income information dissemination and content online, it is natural for us to handhold the markets at this point of time in terms of what's happening and the way to go forward. Please continue to follow INR bonds and as well as spread the word around. And thank you all for attending again on a Saturday morning. And like I said, this is the third of a series of webinars. And we will continue to hold more of such webinars going forward, largely because every day there is a lot of change in the markets happening. So today, the topic is largely on the government 20 trillion stimulus program and what it means for markets and what it means for investors. And today I will focus on where should fixed income investors invest their funds, right? Because fixed income investors at this point of time are in a huge flux. Rates are very, very low, but there is also fear. And given that they're not very, very sure of where to invest, and this is across the community as well, ecosystem, including the fact that advisors to them are also in the same boat, wondering what else can happen to the markets. But before I come back to the slide, where should the fixed income investors invest, I will just take you through very brief on our credit spread score, which we are very excited about. Now, our credit spread score is one of its, I think it's the first of its kind, where we power it by AI. Largely, we provide a credit spread score that gives whoever is consuming the score a fair idea of how a bond is valued in terms of risk. So we have three basic scores. I mean, it's the range is from, in a score, pure score sense, the range is from 0 to 1. And so the closer to 0 it is, the bond is said to be is undervalued. That means the spreads are pretty okay. There is low risk in that investment at that point of time, and there could be chances of improving returns. Then you have the fairly valued, where the bond is said to be reasonably valued on the scale, and it could move either ways. It could move into undervalued territory, or it could move into overvalued territory, and this depends on various other factors that we are tracking dynamically. And the third is obviously overvalued, and overvalued is like in any stock, whether the spreads seem to be on the higher side, on the lower side, and there could be spreads could rise. But having said that, this is not the key. This is not only criteria. Like in stocks, you could have undervalued staying undervalued, and overvalued coming down to undervalued as well. So, but like I said, it gives a very strong sense of what investors or what consumers can look at on the bond side itself. And with this credit spread score, we could actually rate any kind of bond. We have just started with the tax-free bonds. Now we are moving into some other bonds as well, some market products that we like, etc. And as we go along, we should be able to offer this whole score to a wide range of consumers. So it could be IFAs or advisors wanting opinion on portfolios. It could be bond investors wanting an opinion on bonds, etc. So all they have to do is come to our market watch screen and then uh, check if that bond is being displayed, and then they can actually see the scores. Right. So what goes into this credit spread score? Basically, we look at three factors: one is interest rate risk, credit risk, and liquidity risk. And this slide gives you the various factors that we track. But having said that, this is extremely dynamic, and it can keep moving all over the place. Basically, there's some bit of a outlook as well in terms of, for example, interest rates, where the yield curve, how the yield curve shape can move. Credit spread on the credit risk front. What about the company ongoing dynamics in terms of corporate health, the economy health, business health, overall credit market stress, etc., and various other factors keep coming in. Right? So there is no single hard one factor that will drive all these, that will drive all the scores in each of these single factors, right? And then you also have the liquidity risk, which takes into account various factors as well, and also market conditions. So given that market conditions are evolving, especially in such periods, these are not normal circumstances. So we have to actually use that abnormal circumstances as well. So you have normal periods, and then you have abnormal periods, and then you have periods where something unforeseen can come about, right? And all that we look to capture through using artificial intelligence, right? So that's our credit spread score model. And we all have a presentation on the credit spread score. We'll transmit it out to you going forward. Right. So we each factor assigned a weight, and then we give the weighted average credit spread score. So that's a brief on our credit spread score model powered by INR bonds, and we are really excited about this, because I think this could be the single driving force for investors across on how to look at each fixed income investment. Right. So now let's come down to what's happening now. The government this week actually came out and said we'll give 20 trillion package, 10% of GDP, etc. And then slowly, and then every day, the FM has been coming out with a series of announcements, right? And the last 2 days have largely been focused on agriculture, and prior to that, it was on easing migrant problems, etc. But the first day, for the market itself, there was a big announcement that this was clearly this was something that was actually needed for the market, like the Fed taking on credit risk on books. Now the RBI obviously is not empowered to take on credit risk, so the government had to do it. So they said they'll come and take on credit risk. How is that? But one is by backstopping MSME loans, providing full guarantee to about 3 trillion rupees of MSME loans. And then they came and also said that we'll provide 300 billion to buy corporate bonds, especially they said investment grade bonds. But I think it's largely more to do with buying bonds that have become illiquid because of the market freeze, and there is a lot of demand for liquidity by investors and mutual funds as well. So as a specific move, they came and said they will buy the bonds. So RBI's measures on in incentivizing banks through TLTROs to buy credits has not been working, because banks have been extremely credit risk averse, and they don't want anything to do with the credit market at this point of time, given that they've already had bad experiences with NPAs, and they're not very sure how NPAs are going to go going forward, given the economy has come at a standstill. So this 300 billion is a very positive move, as I can see it, and but from the market reaction, spreads have not really come off for the illiquid bonds. So we are seeing some bonds trading at absurd levels. I mean, these levels are really worrying about. You have perpetual bonds trading at 18% levels of IndusInd Bank. Then you have bonds of higher rated NBFCs like Shriram Transport trading closer to 13 to 15% levels. So these are all levels which is not sustainable for the lenders, right? So because the spreads are just not there. So these are worrying levels. So is it because of pure liquidity issues or is it because of credit issues? Now that's for the market to decide. Very difficult to say. But having said that, if the government comes in and says, yeah, fine, we are okay to buy these papers, then it could provide a lot of relief to the markets going forward. And then they came and said they will guarantee 20% of banks' loans either through the market to NBFCs, HFIs, and MFIs, which is also a pretty much positive factor. Only thing is the earlier guarantees didn't work because banks are still reluctant even for that 80% risk they're taking, and they will continue to buy into government bonds. So the biggest issue for the government now is banks are risk averse, and all that liquidity is going into reverse repo, and hence I think what there is the RBI will look to further disincentivize banks to keep money in reverse repo by slashing the reverse repo rate with a rate cut maybe in the next policy announcement, which could come in its policy in June, or it could come in much earlier, depending on maybe once the government has finished the stimulus package announcements, then you could have RBI coming out with some policy actions. Now, so what is this 20 trillion package? I mean, is it really, the government has already announced a higher borrowing program from 7.8 trillion to 12 trillion. And would that be more? I think we spoke about this government borrowing last week, so I've not really dwell on it. And if people who didn't attend last week's webinar, please ask Ketan, he'll send you the recording of that. But having said that, now will this add further to the borrowing? So at this point of time, it doesn't look like. And that's largely because there is the cash outflow for the government is very less. Even if whatever they're doing, for example, providing guarantees, backstop to MSME loans, providing a bond buying, backstop to bond buying, and that will be done through State Bank of India, I would guess, or the nationalized banks, and any other packages they announced. So I think if you really look at it, some of them may be implemented soon, some of them will be implemented later, some of them are reform packages, and some of them some cash outflow. I think the yesterday one was rupees 1 trillion of farm infrastructure. Now, how that's the details of funding is not come yet, whether it will be a direct fund for the government or how it will work, or again work through NABARD. We don't know. Maybe they'll allow NABARD to borrow for that. So it's not direct fiscal move by the government. So the markets, if you look at the market movements as well, the 10-year bond initially rose on that announcement of that 20 trillion stimulus, but then it came off back to where it came from. And then the reason is because the markets are still not worried about are seeing no excess borrowing coming. So what you need to look at is the amount of liquidity that's going to be there. That's largely because apart from the 12 trillion of borrowing, RBI is giving government a 2 trillion ways and means advances, as well as they are issuing treasury bills on a much larger scale. Right? So all that is actually, that will also go into funding the government's any shortfall and deficits in budget. And similarly, RBI is also giving states the ways and means advances, overdraft facilities, and the government can also support the states if required. So we have seen state governments yields come off very sharply in April first week, as I mentioned already in our previous webinars. Yields were at closer to 8.15%, 8.15%, and now it's come down to around 6.5%. So that clearly shows that the market is not is shrugging off supply at this point of time. And when it shrugs off supply and it's continuing to be bullish on the 10-year, then so what you can expect is going forward is could be a bull flattening of the curve. But I'll come to you when I'm talking about the what fixed income investors can do at this point of time. So now, what can happen to higher rate credit spreads if the government actually comes in and buys the bonds? Now, the question to ask is whether 300 billion is whether 300 billion is enough, right? So there is much more demand for liquidity, and who all will get the liquidity? So these are all questions that the market will continue to ask. How much of selling pressure is there across the system? And obviously, all these NBFCs will have primary liquidity considerations as well. So they'll have to come and borrow from banks or from the markets. And how much will that go? And typically, will that go to only the fairly liquid names, or will it go to the other names going down the credit curve? So to a large extent, I think the government should actually focus on not the fairly liquid names. They should focus down the credit curve and the liquidity curve, just to make sure that that good NBFCs, well managed ones, who have been hit by this COVID-19, should actually stay and get stronger going forward, rather than going down the line, going down. Whereas, so you always have the question here is you always have the bad ones also benefiting from this, right? But you can't do much about that. So what does the Fed, for example, when the Fed comes to say, I'm going to buy junk bonds, right? So you have companies that have been completely mismanaged, have just not been able to cope with the competitive pressures, purely been out of technology, but just surviving on some name, etc. They are also getting funding. So there will always be a moral question, but then I don't know whether it's a time to ask moral questions. So the good ones and the bad ones will get, but the main thing is for the good ones to actually make sure that they stay afloat and they stay liquid and they get stronger. The bad ones can get the liquidity, but again, I think investors should be careful on what is the bad ones and what are the good ones. So what will RBI follow-up action, right, after this 20 trillion? So we would expect, I think, more rate cuts. You have repo at 4.4% already low, and reverse repo at 3.75%. And I think disincentivize banks to again park it in reverse repo. So maybe another 50 basis points there, maybe a 25 basis points or a 50 basis points reverse repo cut. Clearly, I mean, even if they do 25 basis points, they'll guide for 25 basis points more. I don't think this is a time when RBI will come and say that we are done, right? So they don't want to spook markets at all. So they'll continue to do that, and I think they will keep liquidity at very high levels. So judging by the appetite of the market at this point of time, RBI need not actually come and do OMO purchases. But if they believe that the long end yields are still too high, they might do Operation Twist. Operation Twist is selling the short end and buying the long end bonds. And the last time they did Operation Twist, the yields came off very sharply, by around 30 basis points. So they might just try to protect the yield curve, and the market will gain comfort from the fact that one is rates can come down, liquidity is going to stay very high, and RBI is there to protect the long end, at least for this time. And then they might actually just start to flatten the curve, right? So I think people who have been interacting with us, we have noticed that we have been very cautious at the long end, largely because of worries of supply. And that's also because, and the market too has been cautious if you look at the curve itself. But the way the markets have been moving, I think we are also slowly changing to the fact that markets are learning to live with the supply, and then looking at the plague in the market at this point of time. And then you could have short-term flattening of the curve, which will mean that long end yields can come off, right? But again, let me come back to this on to the first slide on what fixed income investors can do. So every auction will be a challenge for the RBI because it's 300 billion. Now they're also doing switch auctions. So they announced a switch auctions where they're going to buy the June maturity bond, government bond, and then sell 618 and 579, the new benchmark 10-year bond, right? 618.24 and 579, and this for 300 billion. So this is adding to the long end supply. But frankly, I was surprised by the market reaction. I thought one of the 20 trillion stimulus, then government borrowing higher, and then switch auctions coming through, and then the yields have actually trended up, and then again back to where they were at. So the market reaction has been very, very does show that there is a tendency for the markets to start buying into any kind of yield spikes, right? So I think that will continue to happen. And like I mentioned, SDL spreads have come off very sharply, and that's also a sign that that the market is looking to buy into any kind of spreads available, right? Now there is I'll come to the first slide now on where investors should invest, and but just let me tell you a couple of things. One is the only thing that is certain in the world right now is debt. So everybody is in debt, right? You have government in debt, state governments in debt, corporates in debt, individuals in debt. Anybody owes everybody into debt. So there are very few people who are not in debt, right? In this market, and everything is done through debt, right? So if you look at all the government announcements, it's through debt, so through loans. So they're giving free loans, they're giving this, they're giving that, but everything is through loans. So ultimately, at the end of the day, everybody is going to have some kind of debt or the other, right? So that's the only thing that is certain. And the second thing is that there is no long term, right? So if you're saying I'm going to invest in fixed income for 3 years for tax benefits, I think you'll have to relook at your philosophy itself, because it's not going to work. We are in very, very uncharted territories. We don't know what's going to happen next year. What we can see is maybe short term, medium term, maybe to some extent we can forecast based on the short and medium term what's going to happen in 1 year. But if you ask me what's going to happen in 2 and 3 years, I cannot tell you with any kind of certainty on what would happen in 3 years. So you could have so anything can happen, right? You just never know, and so investors have to be prepared for anything. Okay, so the worst is the biggest issue for the investors fixed income is the tendency for investors, because now nothing is on. They are not getting nothing from bank deposits, right? They're getting nothing from safety products like money market instruments or fixed income or liquid funds, etc. They are getting nothing from. So where do they search, right? Then what we are seeing is a lot of investors, the retail investors, then buying into bonds like perpetual bonds. Now that is very highly risky, and we continue to tell everyone that it is the most riskiest product because nobody knows how to price the perpetual bonds, right? And given that the default of yes bank bonds, I mean, it was written down, shows that the regulatory risk is very, very high for those bonds, and clearly individual investors are not capable of handling that risk. So but the fact is that given that there's nothing they see a certain level of what is it called, they see a yield and then buy, I think, and that habit is going to really burn them. So it's very important for advisors to educate and handhold investors on investments in risky assets, right? Unless if they are able to to a certain factor say that, yeah, this bond is okay, even if it's a perpetual bond, and then it's fine, right? Because they have understood the bond. If they don't, then I think they have to start educating their clients. Then so then you have very long-term products here. There's only certain amount you can invest in PFs and small saving schemes. Then you have obviously tax-free bonds that have already come down. So you have 3 and 5, 10-year, 3 and 10 and 15-year tax-free bonds, all trading in a 5 to 510 levels. And the question is, because this is held by only one segment of the market, that is high net worth investors. And if the yields start to go up, maybe we don't know where the demand is going to come from, where the liquidity is going to come from for this bonds. So there also people have to be careful on investments. But having said that, sometimes the tendency is to look at whatever is available with a minimum of risk in terms of tax fees. We don't see too much of credit risk at all. And liquidity will always be there at some price. Obviously, when things go bad, then impact cost will be high. So right now, if it's 10 basis points on a bid ask, it can go up to say 25, 30 basis points or 40 basis points. And time period to take liquidity can be very high. Right. So these are all typical bond market phenomena. There's nothing new in such markets. People who have been in the bond markets will understand when things go bad, even government bonds turn illiquid. And what happens to corporate bonds, right? Okay, so now let me come to this question which everyone is asked. So what we have looked at, where we have looked at is, sorry, let me go back to the slide. Right here, right? Yeah, coming here, right? So we have now, so what I have divided is into short term, medium term, and long term, right? So what are you expecting in the short term? I think by now, with my conversation, you would have understood that there is a high liquidity will continue in the system, rate cuts will happen, and ultra low rates will prevail for a period of time, right? And this is so, and the short end of the curve will always rates are going to be low. Last Friday last week we saw the 5-year swap coming down to close to 4%. So clearly expecting the rates to come off very sharply. Ultra low rates will be at ultra low levels, and there is still credit stress in the market. And given that the state, we are still in a lockdown situation, flux, and if you look at corporate earnings and guidance, etc., things are not coming in well at all. If you look at economic data, it's not coming in well. Exports were down sharply. All kinds of PMIs were down. So clearly, activity is not there. So credit stress is still very high, right? And so there is fear. And I don't think the people, risk-averse investors, should take on any kind of extra risk at this point of time, given that there is still a lot of fear in the market. But you have a steep yield curve. And so if you have a steep yield curve, what do I mean by steep yield curve? So you have the 1-year government bond at close to reverse repo rate, and then 4% plus levels, and then you have the 10-year government bond at 575 levels. And if you take the old benchmark bond, it's at 6% levels, and then you have the long end bonds at around 680, 690 levels. So the curve is almost about 100 to 100. 1 over 10 is 100, and 5 over 10 is about 85 basis points, and then 78 basis points, I think. And then you have 68 basis points, and then you have the 1 over 30 would be at around almost 200. Almost 200 basis points. Let's say about 180 basis points. So this is a very steep curve, right? And to some extent, if you see the market reaction, as I said spoke about it. Every time the yields have gone up, it's tended to come down again. Clearly, the markets are buying into any kind of spikes. So they could, if the government is saying that they're not going to add to the borrowing for this year, at least for now, and then the rate cut expectations go stronger, And globally itself, you see the Fed now talking about recession, etc. So they're going to keep rates low. And so you could have a very short-term phenomenon where the 1/10 spreads come down. That is a 10-year yield start to trend down. So you're at 575 now, and then maybe you could go down to 5.5, or maybe it could be lower. And then so you can look at curve flattening strategies, right? And again, I'm cautioning you here that investors who don't understand curve flattening, or advisors who not able to understand the whole concept, maybe should not be able to advise their investors to do that. But people who can advise it, but for a very short-term basis, and you could also this could also filter down into anything that depends on the curve. For example, uh, liquid PSU bonds trading at trading at spreads over the government bond. Now, if the government bond yield goes flattens, then you would have the spread curve for those highly liquid bonds actually coming off, and even spreads coming off, as well as a curve can come off, and that could provide you some uh, short-term gains, right? So you could have both safety as well as returns at this point of time on those bonds. And there definitely is there is you can definitely look at such kind of short-term movements there. And what I mean by short-term is very difficult to give a period of short-term, whether it's 3 months, 6 months, 1 year. But I think I would define short-term between 3 to 6 months, right? And then we go down to the medium-term strategy. So what happens when the yield curve flattens, stays down, right? Then what happens? So now the market will lose appetite. They don't have anything to play for. They can't play for steepening. They can't play for flattening, and the rates will stay down. Then supply will be constant, etc. So the markets will have to start searching elsewhere. And so here maybe investors can look at slightly less liquid credits, but are still very, very high safety, right? In terms of credit risk. And then if the spreads are very attractive, then they can lock onto the spreads at that level. So what this will do is prevent, even if the curve moves up at the government bond side, the spread curve will actually come or compress, largely because such yields will stay sticky at that some levels, because nothing is going to change in the underlying. Rates are not going to rise, and the liquidity is not going to go away. So the spreads can be pretty comfortable. And then you have at the long term, now so if I'm talking about medium term, then you have 3 to 6 months, 6 months to 1 year maybe. And then you have the long term, which is after post 1 year. Like I said, I mean, there's no long term now at this point of time. Anything can happen. But then there can be a case where in the long term, if economy stabilizes, then central banks will have to start looking at normalizing. Inflation can rise from a very low basis. There could be lots of supply constraints. There could be push up prices. So already we are seeing that governments are buying agri products at well over market rates, right? So MSP is still higher. And so if it's going to stay down, then food prices can stay up. All that can happen. So you could have, then once the whole curve starts to move up, then everything along that start to move up. And the problem is nobody can sell, right? So typically we have seen many cycles where banks are stuck with government bonds, investors are stuck with bonds which they thought they're going to buy for long term, and then at very low levels, and then they start to see that yields are actually 200 basis points higher from where they bought, or 300 basis points. They can't do anything about that, right? And then, but even worse is we've seen one cycle where floaters, right, floating rate products were issued. A huge amount of money went into that, but then and these floaters were hedged against swap rates, and the swaps started to move up, and the floaters started to lose money. The product started to lose money purely because of mark-to-market values of the swap, and that unnerved investors. And again, floaters are highly illiquid. So in that sense, in the long term, I think if there is some stability, then I think the best investment is going down the rating curve, because if the economy starts to stabilize and balance sheet starts to improve, then good credits at very extraordinary, very, very high spreads will be able extraordinary returns. That's it. I mean, that's something for very highly knowledgeable investors who understand credit risk and who are able to do credit research, or who are able to depend on people who know who can do good credit research, right? Um, uh, uh, and that's going to be the key factor. And this is not for everyone, right? So everything I'm saying here is not for everyone. Low risk investors will not understand many strategies. Low risk investors may want to stay low risk, not take any kind of risk, which is fine. They'll have to live with the low returns, which they're okay with. Higher risk investors can understand higher risk and they can start to adopt such strategies. But again, with risk investors, I think there is a differentiation between knowledgeable and not knowledgeable. So people who understand what they're doing, they can adopt strategies. People who don't understand what they're doing, either they have to be handheld, or they don't need to invest in any strategies they don't understand. So now, now what would be the best product? I mean, if you really look at it, would be a good floating rate product, uh, which is benchmarked to a good rate that can actually move along with that. But then we don't see too many floaters around. Government issues floaters, but the pricing is very warped. I mean, it's very difficult to understand the pricing as well, because we don't have the a robust yield curves for that, right? So we can't. It's very difficult to forecast um, where could 3 month yield or 6 month yield be down 2 years down the line. Yeah, typically you have floating rate FRAs that actually tell you price the yields 2 years down the line. You can actually buy into that, but that's very exotic, and again, it goes into the realm of derivative products, which can be only managed by treasuries, and not by individual investors or general market as a whole, who don't really understand such structures. So I'll not really go into that, but these are some things which you can look at. And obviously, I think what we can definitely also look at is come and recheck is use our credit spread score model, and which will let exactly know. I mean, give you a fair idea of what is fairly valued or undervalued or overvalued. Right. So with this, I'll stop, and I will uh, I'll take on any questions you may have. Uh, uh, yeah, any questions you may have. Just before that, I would like Ketan to share that market watch screen that we have, just to take you briefly through what we provide on that market watch screen on our bond price discovery platform. You can start asking your questions on the chat, or if you want to ask questions, you can raise your hands, and I'm glad to answer that.
Hello.
Yeah. Okay.
So share the screen.
Yes. Okay. So you can see the market watch screen. This is our market watch screen on our bond price discovery platform. This gives you right now we have only put out all the tax-free bonds that are there. So basically, it gives you one is the bond description. You have the rating. You have the coupon rates. This is fine. Then you have the last traded yield. You have the maturity. Then you have the credit spread, and then you have what is it called, a fair yield, fair YTM, which is a fair yield. So if the fair yield gives you the range at which it's comfortable to trade, right? So in that sense, if it could be between the last traded yield, or it could be higher or lower than the last traded yield itself. And the last traded yield itself depends on various other factors, especially for tax-free bonds, right? But the fair yield will give you a very fair sense of where, if you're an investor, or if you're an advisor and want to buy bonds for your clients, and then if you're wondering, I mean, what is the right price to deal at, then the fair yield will give you a very fair idea of what's the right price to deal at, as in what price you want to buy or what price you want to sell, or within that whether you can transact. So it's very fair, and then obviously there's a dynamic factor. Then you have the credit spread score. Then you have the credit spread score, as I mentioned, that gives you the valuation in terms of overvalued, undervalued, or fairly valued, depending on the score, right? So this is a market watch screen, and right now we are on tax-free bonds, but we are expanding it slowly as and when. And you'll see as we go along, you'll see much more products, much more bond being listed here than just tax-free bonds. I think as early as next week, right? So with this, let's start taking questions. Okay, I'm looking at my chat, and Ketan, if you have anybody who raises hands, you can unmute them. I will look at the chat and answer the questions, right? Okay, so let me just start from the first. We have Chetan Gill, who's asking, so what is your take on FT, the recovery for investors in the current scenario? Okay, so I think the FT portfolio, from what I saw, apart from liquidity, except for I think Future Group, which has been written off, I think the other bonds seem to be on course to at least give you the cash back. But I mean, having said that, I don't have any. I've not really thoroughly researched the portfolio as yet. But some bonds were purely, I mean, they just couldn't sell clearly. And but as the cash flows come in, the investors will get the money into will slowly start getting the money. And hopefully, I think even if 90% of the portfolio is able to generate that kind of, if they're able to honor their commitments, then the investors should get at least 90% of that money. Yeah, but I just caveat, we have not really gone into each and every bond there, that portfolio. Maybe once we start looking at our credit spread score model, then maybe we can have a better idea on that. We'll keep getting back to you on this, right? Or you can keep contacting us on this as you go along. Okay. Do you recommend rundown strategies at this stage? Now, like I said, rundown means 3-year, 2-year, and 1 year. Buy a 3-year bond and hold it for 3 years. Like I said, there is no such thing as long term, right? So you might want to invest in a rundown strategy, but make sure that you're able to exit the investment, that it should be liquid. That's the most important thing. Liquidity should be the most important factor for you, because even any hint of normalization and rate inflation rising, the curve can move up very sharply, right? And so you might not want to get down stuck with a illiquid investments where you entered at some level of yield and then it's going up. But then if you think the spreads are reasonably okay, then you can definitely look at rundown strategies. But then make sure that you're not stuck to a hard and fast rule of 3 years, or right, for taxation gains. Because what we find is most people look at taxation and then they lose capital, and we don't want that. Okay, so again, Chetan, some MFs are holding state government loans as opposed to SDLs. What is your take on the safety and liquidity of state government loans? Now, SDLs are state government loans, right? Unless these are, if you're talking about state government guaranteed bonds, now that is a separate, by itself. So it really depends on the commitment shown by the state to the state government guaranteed bonds. We all know that states don't have money, and we all know that they are delaying salaries to their own employees, and we all also many seen, like I'd mentioned, I think in our last 2 webinars itself on state government guaranteed bonds, that there is it's not a state government loan. It's not a direct loan taken by the state government, because that the RBI manages for them, and that they make sure that the loans are serviced to the market. But here there is no safety guarantee, and we don't know how those entities are being run as well, right? So if they are state government guaranteed bonds, I think you have to do more research on each bond that they are holding. Now, I can't comment on that what are those bonds they're holding, because I have not seen that. But specifically, if you have any questions, you can always come back to us with the bond, right? Later down the line. So I have Prakash. Which type of product we should recommend in current situation of client not wanting more risk, right? So I think you should recommend the highest low duration, high safety, high liquid, and low credit risk products, right? So depending on the portfolio, I think that's the best product you should look at. Um, Maybe short-term income funds, right, which could provide some kind of accrual as well, and the portfolios are very liquid. So I think these are the products that you should look at for investors who do not want any more risk, right? But again, you don't recommend and then just sit on that. Keep monitoring that what you have recommended, and then come back and then keep providing the investor with more information. And if necessary, if you think yields are going to move up, then you would have to tell the investor to start moving out, right? Rakesh Shah, what's your view about longer term GOI? So I just mentioned that there could be a strong case for a flattening of the curve. So that means, like I said, if the curve is flattening, that means the short end rates stay the same or fall much further than the longer rates, and the long end rates can fall much further than the short end rates. And if that happens, the long end GOIs can give you good returns. But like I said, you have to take that risk. It's always a risk game. So if you are able to handle that risk, then you can take an exposure to long end of the curve. Would you recommend looking at gilt funds at the moment? Yes, long end of the curve. Again, I told you, this is Kanika. You could invest, but it's a risk, right? So if you're able to handle the risk, that means if you're able to ride out risk by, say, if it rises by 25 basis points, 30 basis points, and see prices falling, that's the kind of risk you might have to ride out, right? But but if you want to take that kind of risk, it's a risk return trade-off. And I do see at this point of time the trade-off seems to be pretty favorable for investors. But again, this is not for everyone. This is for investors who understand the long end of the curve, right? Chetan Gill again, view on 10-year benchmark or longer term in the shorter to medium term. Yes, I just told you about it now. I think we can have a case for yields coming off, flattening. But again, if you are able to take the risk, then you can definitely look to you can look at investments there. But like I mentioned again, you have to learn to take that risk, right? Again, same question on G-Secs. Yes, short term, 6 months to 9 months, difficult to say. 3 to 6 months, like I said, you can look at the longer end of the G-Sec curve. Right. How has been participating of the banks in the special liquidity situation? Very bad. The first TLTR was only 50% subscribed, and banks are rejecting that other one because purely, I was speaking to one small finance bank, and they said they just didn't want to take on exposure to any risk, MFIs, especially, and other bonds, illiquid and lower rated corporates or NBFCs. So it's been very bad. So that's why the government had to come and say, I'm going to take on credit risk, right? Your view on IndusInd 22 maturity paper trading at and above yields. Oh, now it clearly infers that IndusInd Bank, the market is clearly worried about IndusInd Bank. Now, whether worry is right or wrong, I don't know. Right? It's not. I don't want to comment on this forum. But any bond that is trading at 15% plus, especially with the rating as it is, and then if you look at the corresponding bonds that are rated similarly and trading at lower levels, then you need to start worrying. So you always have to ask the question, why the market is doing this? Why is the market dealing with the bonds at such high levels of yields. So is the market telling you something? Always question that. The markets can be wrong, right? Many times it can be wrong, and people who think it can be wrong, they make the money. But then if they think it can be wrong and the market is right, then they lose a lot of money here. So clearly, I mean, I think if the market is saying something, and if you look at the way the market behaved on Yes Bank bonds, it clearly did say something, and the way it turned out, the market proved to be right. But for this bank, it can be wrong, right? So hopefully it is wrong. I mean, I'm hoping it is wrong because IndusInd Bank is a huge bank, and so nothing should go wrong. But the point is, the market is trading like this, so it's not a fact that can be ignored, right? So be very, very aware of the risk. That's about it. That's all I can say on this. But clearly, I think it is a worrying signal. Your take on government borrowing program, is it going to be inflationary at this point of time? No, they're not inflationary. Um, that's largely because we are going into a recessionary scenario. But going forward, now typically when government borrows and there is inefficient allocation, right, from the government, the private sector has got much better efficiency in allocation of resources, and typically that's a worry, is that the government borrowing is normally fiscal deficit, normally inflationary. But we are in extraordinary circumstances, so it may not be inflationary, at least for the next maybe 1 year or even 2 years. We're not very sure, but yeah, at this point of time, it's not going to be inflationary. And at some point of time, government also wants inflation, right? So they have to service the debt, and the nominal GDP has to be higher. I think 10-12% is what they'll be looking at in terms of nominal GDP. And so if they want that, they have to have inflation. But right now, they don't want deflation. So that's the reason they are spending so much. Right. So from Preetham, as long as growth is not coming, the only comfort we would have, that government is going with a going concern. They would be able to manage. Yes, I think it is government. It is a government and central bank act at this point of time, because private sector has nothing to do, cannot do anything much. And globally, I mean, that's what's happening. The Fed is actually telling the US government, you spend more. I mean, fiscal deficit is a problem, but we want you to spend more because we don't see growth happening for a long period of time. And while we will do what we can, but they want the government to start being more fiscally loose. Similarly, the ECB is telling European Union governments the same thing: spend more, spend more, spend more. Don't worry about the fiscal, right? So clearly, I mean, like I said, the only thing that is certain in this environment is debt. So the more debt they take, the more you have to take debt and you have to spend, and the debt is cheap, right? The problem is what happens if the people are holding that cheap debt going forward. Now that's a question that has to be asked later down the line, right? So you have Anju Kumar. Would you recommend PSU debt banking funds and good quality corporate bond fund to invest? Yes, if the bonds are liquid, if the spreads are pretty decent, yes, we can recommend. You can recommend, right? And it depends on what you mean by good quality corporate bond fund. The main thing here should be liquidity, and also safety of principle, that no downgrades, etc. Right? So you have Mega 4. Where should client invest for next 2 to 5 months? Sandeep Gandhi. So Sandeep, like I mentioned, 2 to 5 months, I think the best place could be at the long end of the government bond curve, or could be on corporate PSU bonds, highly liquid PSU bonds and corporate bonds, which are trading at a spread to the government bonds, because these can give you some very decent returns if the whole curve starts to flatten, right? But again, keep mentioning this over and over again, because the biggest issue which investors faced, especially with investments in credit products, was at the investor level and at the advisor level, nobody understood the products, right? And so given that, if you're able to understand the whole movements of the curve flattening and the risk you're able to understand, yes, you can invest in 3 to 5 months. You can invest in government bonds at the longer end, gilt funds, or into funds that invest in, or you can invest directly into PSU bonds, corporate bonds, liquid, or funds that invest in such bonds. Right. So please update on confidence index, also on global financial risk factors. Okay. Now, confidence index is it consumer confidence? Not exactly. Okay. The confidence index is the confidence at the both consumer level and at the business level. I would suspect on whether people can buy more or invest more. So clearly, I mean, the higher the confidence, that means there is tendency to consume, there is tendency to invest. And at lower confidence, so there is less tendency to consume and less tendency to invest, and people will preserve cash. So very simple on that. Also on global financial factors, risk factors, yes, global financial risk factors, economies going into depression, then uh, which is going to have a contagion effect globally, as then growth staying down at this point of time for a long period of time, more pandemic effects than US China trade wars, US elections coming up. So many factors are there, right? So there are a lot of global risk factors that can filter down to emerging markets as well. Then currency, so much of debt is there globally. US Fed balance sheet is over 7 trillion now. It was just about 4 trillion in March, right? So they are like pumping up their balance sheet size. ECB is buying, so everybody is buying everything. Japan is buying ETFs. They're buying into corporate bonds, etc. So we don't know how everything is that. We don't know how things are going to look going forward, because at such low rates you get nothing. Then savers are getting nothing, right? So how do you service pensions going forward? Then you have oil prices that are down. So you have one whole huge trillions of dollars of world oil economy down by almost 50-60%, right? So where is the consumption going to happen? So many risk factors are there. Gaurav, risk of sovereign downgrade. Yeah, correct. Government income, yeah, that's normal. Government income has decreased and borrowing is increasing. That's what is happening now. Risk of sovereign downgrade. I don't think India will go down so badly. And also that fact that globally itself, the government is not really a borrower in the global market, so it's not really going to affect domestic bond yields. Also, that I think global markets have always treated Indian issuers as much better than the rating suggests. So unless they see an on the ground impact on these issuers um, uh, due to any kind of an economic factor or balance sheet factor, I don't think it's going to. I'm not really too concerned about global downgrades on the bonds or the currency as well, right? What is supporting your view of yields falling from all-time low levels? We are not at all-time low levels in terms of the 10-year bond is still way off about almost 75 basis points from all-time lows of 5% and below. So we are not still at all-time low levels. We are still some way off, right? But the point is it can trend down to all-time low levels largely because of high liquidity, more rates, and the fact that there is some opportunity available for the markets to play for some kind of a yield curve compression at these levels. And and the fact is, right now ultra low rates can stay for a while. That's the premise of the market, and with that, I think they would rather take on the longer end where there is enough juice available, rather than the short end, which has already factored in everything. So it's purely market positioning and sentiments, and the question is how much can it go down? Not very difficult to say, and how long can it stay down? That's also very difficult to say. But at these levels, I mean, if there is enough risk appetite, then definitely there is something to play for, right? So you have Chetan, banking and PSU debt funds fare strongly on safety, liquidity, and are well positioned on 2 to 3 year duration. Does the strategy? Yes, if the portfolios are highly liquid, right? Um, and on 81 bonds, some MFs hold about 10 to 50% of scheme AUM, considering yields are going north. Doesn't that strategy look wrong? I think they got caught on the wrong foot there. If it's 50%, that thing's way too high. 10% manageable, because the others 90% can 90% can provide the enough comfort to take care of the 10%, right? And if they're holding very highly liquid bonds, for example, SBI and HDFC Bank, they're okay, because those yields have stayed at around 8.5 to 9% levels. The others have obviously there's no liquidity and they're going up. And hopefully, I think, yeah. So at the lower end of the exposure scale, I think the funds are okay. But at the higher end of the exposure scale, the funds become very liquid, and that's not a good fund to invest in, right? Tias Ghosh, what is your expectation of 3-year PSU and PFI spread coming in next 2 months, given that repo is at 4.5? Yeah, so I had mentioned, I think these spreads can come down. Not maybe 40 basis points to 60 basis points, you have to see, but then definitely they can come down from higher levels. Yeah, like I mentioned, I mean, they can come down. So Vikram is a high. RBI has directed all banks to skip dividends for current financial year. What are they? What are the rating? What are they rating as a good strategy for informed investors? Would that be a wise one, considering that there would be already stress in the credit space with lots of names under stress, and the pandemic could have only worsened the situation? What if the situation continues like Spanish flu, which lasted for 3 years? Yeah, I think dividend, asking banks to not give dividend is a good strategy, because they want them to conserve their capital. And if they conserve their capital, they can actually stay at reasonably good capital adequacy levels and continue to lend to the economy, rather than pay out the cash into and also ride out any kind of long-term stress that can happen, like we had mentioned. Yes, so I think the expectations are that this whole thing can last well over a year. So you would have to be prepared. The strong banks are the ones that will be able to keep their ratios high. And also banks that can be supported by capital infusion, like PSU banks or good private sector banks that can raise capital from the equity markets, right? And yeah, so I think slashing dividends is a good is correct. Is what RBI did was a correct move. What's your view on AAA papers? Average maturity 7 to 8 years, 10 years, 2 to 3 years, which are preferable? I think 7 to 8 year, 10 years, PSU, AAA bonds, the liquid ones, and the 3 years, both are okay. So 2 and 3 years, we see that the spreads are still reasonably valued. They can come off. The 7 to 8 years can also come off. The spreads come off if there is spread yield curve compression. So the higher risk investors can take exposure to the 7 to 8 years, and the lower risk investors can take exposure to the 2 to 3 year tenure, right? So depending on the risk preference of the investor, I would not put this to all investors. Like I said, you should be mindful of the fact that there are two things that all of you have to be very, very mindful of the fact. One is risk preference of the investors, and the second is knowledge levels of the investors. So if, if the investor has no clue on what they're investing in, then I don't think that they should invest at all, right? Even if you think it's a great investment. So best not to do that. So depending on the risk preference and definitely you can look at both 7 to 8 years and 2 to 3 years. So how has been the historical spread of the 10-year GSEC? Can we draw some inference? Very difficult, because we have seen 10-year GSEC yields even trading even below repo rates many times. Here, the markets have been playing for a yield curve repo rate cut going forward, right? So you have a very, very flat curve, or you even have an inverted curve. And now you have the spread at about 130 basis points, which has been very high. And I think the spread has been pretty high for a while. The markets, so the long end has always been worried about the supply of the government bonds rather than anything else, and liquidity. But now with both, supply is still there. That's the biggest worry. But how do you look at it? I think the only given factor, like I said, is debt. So supply will always be there. So now the market has to live with the supply. So how does it want to view the supply? So whether it wants to view the supply thinking that yields can go up, then it will sell off. But at this point of time, the market is saying, okay, supply is going to be there, but there's so much of liquidity and I need to have some kind of a return. So let me buy the long end of the curve. So that's how the market is looking at this point of time. And can we draw some inferences of it by looking at, yeah, like I said, investments in gilt fund at this point of time, yield curve compression is possible. So definitely you can look at investments in gilt funds. But again and again, I come back to the fact that you have to understand the yield curves. You have to understand risk. And so if you understand both, then obviously you can look at it. But if you don't understand both, then either make sure that you understand, or you can just plainly avoid it. Yeah, I don't see any more questions now.
We have a question from Tia Ghosh, and I'll unmute her. Yeah, Tia.
Sure.
Ma'am, please go ahead. Hello.
Arjun, you've already answered my query.
Okay, fine.
Thank you.
Oh, okay, fine, sure. Right. Any more questions we have, Ketan? I don't see any on the chat.
We don't have any questions.
So, okay, fine. Yeah, thank you all for attending. Yeah, and it's been a pleasure. And hopefully all of you got some good feedback from this, takeaways. Please do let us know if you have anything that you require. And like I said, INR bonds is the best source of information and for analysis and reports. And now we are providing a bond discovery platform, as well as a place where you can actually place your bids and offers to our order book screen. And yeah, and enable price discovery, enable much better informed decision making, right? So thank you again for attending. Yeah, we are closing the call.